All right, what's up? What's happening? Welcome to Gentlemen's Council. As we continue our series on building generational wealth, today we're going to be discussing insurance and why it is the best kept secret to building wealth. Today, I have my girl who actually helped me get my family insured, Teyha Peters. What's up, Teyha?
I am doing well. Thank you so much for having me. And I'm a tweak it just a little bit. My name is Teyha. I know it can be
Teyha?
a little bit. It's Teyha.
Oh, I've been
I
calling
know
you Teyha and you've
it's
never corrected me
I,
before.
I did it in like in I think text or maybe once or twice in on like an appointment or something. But it's Teyha. No, it's probably the way that it's spelled. It's okay. I get it. I get it all the time. I'm not offended at all. But it's Teyha. And so thank you so much for having me. Insurance, retirement planning. Don't know how the heck. At first, I was like, how the heck did I end up in this? And I'll tell you a little bit about my story in a moment. But thank you so much for having me. I think what you're doing is great. A lot of people need, just the basics, the foundation on how to build wealth, and insurance is actually one of them. So I think what you're doing is great. Thanks for having me.
Thank you. Thank you. Thank you. So let's get right into it then. What is life insurance?
Life insurance. Well, there's a couple different, ways. There's the typical definition, which is like a contract between a person and an insurance carrier, basically saying that in the event that something happens to you, your family is going to get or receive a death benefit, right? A lump sum of money. So it's just pretty much you protecting yourself in the event that something happens, but also being able to leave a legacy for your family as well.
Okay. So one of the biggest questions, as I talked about life insurance, was what are the different types of life insurances? Can you go over and break those down for us?
Sure. So I think also when it comes to life insurance, we typically only think about one type. Most people are only really exposed to one type, and this is why it's so important to make sure that people are getting educated rather than pitched. So when it comes to life insurance, there's really three main categories. There's term, which is probably the most common. There's another one called ROP term, which is it's a type of term policy, except you get a return, right? There's a return of your premium. That's what ROP stands for. And then the last one is permanent life insurance. And then within permanent, you've got all these different types underneath. So it's kind of like an umbrella term, permanent insurance. But I'll sum up each one. Term is very simple. The good thing about it is it's inexpensive, which is probably why it's the most common. The downside to it is, it expires, right? So after maybe anywhere from 10 to 30 years, this policy will lapse, which means the cost that you've been guaranteed for the past 30 years will increase. And so that's what they mean by expire. It doesn't mean that your coverage is done, but it means that 31st year, the cost is going to jump significantly. And I've seen this with quite a few policies. And if you're not familiar or have not looked into your policy, some people may not know when that day is. So that's a term policy. I've seen people get it if they want to, cover like a mortgage if they pass away, debt. A lot of people don't know debt can be inherited by their spouse. So debt, and then sometimes children, making sure your children can go to college. So that's term. With ROP, it's a little bit more expensive than term. But I've seen people, use this policy just because they're kind of like, if I invest into this life insurance, and this comes from maybe a lack of fully understanding how insurance works, but some people are still a little bit, on the fence about it. So the way this policy works is when you get the insurance, again, it's a term, so it may last 10 to 30 years, anywhere between that time. You get your money back at the end. So every dollar that you've put into that policy, assuming you've never used it, you would get it back. Now, the challenge here is I know a lot of people who get excited when they hear this, and they're like, well, great, I'm putting money in. If I don't use the policy, I get everything back. But if you're going to put money down for 30 years, wouldn't you want the value of it to increase rather than decrease? Most people would say yes. So if I put down a total of $30,000 over the course of, let's say, 30 years, right? When I get that money back, I got to ask myself, is the value of that money going to be the same? No. 30 years ago, you could probably do a lot with maybe $30,000. Today, you're not even going to make it in California with that, to be completely honest. So $30,000 30 years from now, who knows what that's going to be, especially with the value of the dollars going down. A lot of people don't know that. I want to say about 40% of all of the money ever printed in the United States was printed in the year 2020. 40% of from the time we began as a country to today, or at the time of 2020, I would say 40% of all the money ever printed was printed in 2020. And that was because of the stimulus checks and them trying to jumpstart the economy all over again. So paying attention to inflation, cost of living, those are things you got to consider with ROP. And then with permanent policies are your whole lives, your IULs, there's GULs, there's all these different types, but permanent policies just mean that they will last what is considered a lifetime. And so that can be, there are some that's like 95, 99, 105. But essentially what happens is you get this policy early on in life, or whenever you get it, and you lock in that rate. So whatever the cost is at that time of purchase is the cost it will be for till the end of your life, basically. So permanent policies are a little bit better for people who are looking for more of like a long-term policy, basically.
Yeah. So the funny thing about this, especially for me, the only thing I really knew about insurance was term, right? Mm-hmm. And so I looked at term, especially, I mean, let's be clear, especially as a young man, right? Uh-huh. You're like, what am I gonna do with that? Like it's over in 20 years, like, you know what I mean? And so you like, and that's where I think and that could be where the scam part comes in from, right? Like, okay, I'm covered for the best 20 years of my life, quote unquote, right? So, at this time I'm 20 and I'm thinking, well, it's over with when I'm 40. Like, okay, no, I'm a definitely need it 40 to 60. I think that's when I'm starting to decline a little bit. So, you know what I mean? I guess that could be the reason why, we probably grow up thinking that possibly, especially in our community, that it's a scam. So let's, okay, go ahead.
I was going to say, did you want to kind of like debunk that?
Yes.
Okay.
Yes.
Cool. So the whole idea of insurance, right? I think the idea first that's hard for people to wrap their mind around is I'm paying for something. This is just kind of like the mindset that people have when they think of insurance is I'm paying for something that I'll never see. I'm paying for something that I will never really reap the benefits of. Right. And this whole topic can go a lot deeper, has a lot to do with forward thinking and, making sure that we're thinking about the people that, that come after us and all those things. But I think it's very interesting. Nobody would say that, building generational wealth or leaving a legacy behind for our family is a scam. So where does this idea of life insurance, being a scam really come from? We think about car insurance, right? People pay car insurance. Nobody's questioning car insurance, right? Nobody's questioning insurance, your warranties on your appliances. Apple Care is insurance. We don't question whether or not we should insure our iPhones. And I think it's very interesting because we're willing to protect our home, our cars, our watches, jewelry, appliances. But then when it comes down to insuring ourselves, all of a sudden it's a scam, right? We insure all of those things except the one thing that uses all of those, and that is us, right? So to go back to, whether or not it's a scam, insurance, just to answer you straightforward, it's not a scam. It's not a scam. It's a tool. that you can use for a couple different reasons. One could just be to say, hey, I want to make sure I'm protected. The other could be, I want to build some type of wealth. And that's the one that a lot of people are not familiar with, is how to leverage life insurance to build some type of legacy for yourself. And so to go into the mentality of that is the challenge that a lot of our community has had is thinking beyond today. Right. When we think about purchases people make, right, we'll buy the most expensive pair of shoes, the most expensive cars, right, because it makes us feel good today. Right. Versus looking at, maybe I can save that money and I can put it somewhere where it's going to, build something for me later. Right. It's not only an issue in our community. It's really a big part of society today. It's instant gratification. Right. It's very hard to understand insurance because there's not really an instant, there's not instant gratification when you get life insurance. And I'm just being honest. It's not a tangible product. It's not something that you can just pick up and drive off the lot with. It's something that you physically cannot touch. You cannot physically put your hands on a life insurance unless you're talking about the physical policy itself. But most people, they don't see the value in it for that reason. So it's very hard to wrap your head around life insurance when your mindset is not forward thinking. That could be a huge part in why people don't see the value in it. And ultimately, they're thinking, well, this is a scam, right? And if you're not sitting down with somebody that's educating you on it, right, versus pitching you, those are very different. So when you sit down with somebody and you're being pitched on why you should put $100 a month into something that you don't understand, yes, it's going to seem like a scam.
And no, it's not a scam, but I'm very direct with people. I feel like it's a selfish thing. If you don't insure yourself, you know what I mean? It's selfish because now you're putting it on someone else to bury you, to handle your affairs when you're gone. It's a lot. So especially when, I guess the piece that we're going to definitely get into as far as growing generational wealth, it definitely keeps you in the cycle of now someone continues to pay for, your debt.
Yep. I say it all the time. The generational wealth is generational. Generational poverty is generational as well. You get to choose which one you want to be able to pass down. It's very simple, right? So people just like we had this conversation before, you got to make a decision as to whether or not you want to be the person that's going to, change that. Are you going to be the person to continue that? And which one do you want to leave and pass down? And that's completely up to the individual, right? So I think that's very important. That is important too.
Okay. So now let's talk about getting insurance and that process. How do we go? Now I've made up my mind. You know what? I see the benefits of insurance. I don't really know which one to get. So let's talk about, the different insurances on which one to get and why you should get which. So let's talk about that process. How can I get insurance? Where do I go? Where do I even start the process?
Yeah. So today, we have this might have been a different conversation 20, 30 years ago, when technology was, still new and there wasn't, social media and things like that. But today, your best bet, and this is just me being completely honest, your best bet right now, if you're looking for insurance, is to find some kind of broker. Right? Find a broker. And I'll tell you why. There's no bias, right? If I go to State Farm, guess what they're going to try and sell me? State Farm products, because that's all they have. So they're going to try and give you the best of what State Farm has, right? And what I do know about insurance is it's not one size fits all. Right? Which means I may go to State Farm, but what if State Farm doesn't have exactly what I need? And I'll go into, how you determine that. But, if you go to a broker, right, where let's say they work with 10 different companies, right?
Mm-hmm.
They can figure out what your needs are, and they can kind of search around, kind of like Expedia, right? And look around and see, okay, this kind of fits their budget, but this is what they need. Okay, this company has this company has that. And so it makes for a better product that's customized to you, if that makes sense, versus one particular company. And I know there are companies out there with commercials, and we've seen certain commercials for insurance companies. So it's like ingrained in our mind, like if I need insurance, I'm going to go to this company because I've seen it so many times. But it doesn't necessarily mean that they have what's for you, right? And so when it comes to looking for insurance, I would say your best bet is to find a broker, find a broker that has multiple carriers. If you're going to look for insurance. And then how do you figure out, what do I actually need? There's a couple different ways that, you can go about insurance. A lot of people never sit down with someone that actually goes through the proper steps, right? So some of the steps is, I've always found that people are either overinsured or underinsured, right? And when I sit down with people, I want to try to find whatever is just right, like based on their needs. So professionals today will use something called DIME, right? It stands for debt, income, mortgage, and education. And this is used to determine what is the minimum insurance need of a person, okay? So debt, right? You look at debt. How much debt does a person have, right? Do they have student loan debt? Do they have credit card debt, medical bills debt, right? You factor that in. You look at their income, right? Because in the event that something happens, let's say they get sick, or even if they pass away, their family may be dependent on their income. So we factor in income. Now, according to LIMRA, right? LIMRA is pretty much like the head of the insurance industry, pretty much. And LIMRA says that it takes about a decade for families to pretty much get back on their feet after losing someone, to completely, recoup. So the way that you determine, a part of how you determine that insurance need is you take the income, right? Maybe monthly. If you have annual, you could use annual. You multiply it by 10 years. So let's say somebody makes 50,000 a year times 10, they would need 500,000, right? They'd be able to live off of that for 10 years. And then you factor in mortgage, right? How much is left on someone's home? And then from there, you go into, you add that up, you add education. If they have children, how many children? How old are the children? These are all things that have to be taken into consideration. And once you get each of those amounts, you add them all up. And that's how you determine someone's minimum insurance need. And of course, there's all different types of variables in there. I've seen situations where someone maybe has a kid who's younger versus a kid who may be like 16, 17. And that kind of can shift the amount of money you put towards education. E stands for education for the kid. So yeah, that's pretty much how you could determine someone's coverage, like how much insurance do they actually need. So, yep.
Okay. So we're gonna make sure that everybody get that. So 10 years, right? You said multiply your income by 10 years, right?
Yep.
Your debt, add up all your debt that you have.
Mm-hmm.
So your mortgages, all of that, add that
Mm-hmm.
up, right?
Yep.
And then you said kids.
Mm-hmm.
Kids needs education.
Yep.
Add that in there as well too. Am I missing one?
Nope, that's it. So you combined, mortgage is also a part of the debt. So that's the other one. And sometimes education and, just the way how things are shifting nowadays, sometimes that money that you leave for education may be used for a kid to start a business. Every kid's not going to college today. So yes, we put that money aside and, we account for education, but in the event that the kid says, hey, I want to become an entrepreneur, that check that's written to the family is in the form of cash. It's a check that you can cash out on. It doesn't necessarily have to be used for education. They could use it to start a business as well.
Okay. Okay. So let's keep that scenario going. So so now I realize based off of what you said, so I make $50,000. So I multiply that by 10, so 500,000, have a mortgage of 200,000. So
Yep.
now we add that in.
Yep.
So now it's 700 and I have 60,000 in student loan debt, right?
Yep.
Don't have any kids right now. So we're looking at 760. Okay. So now we come to the conclusion that I need $760,000 in insurance. Okay.
Yep.
How do I qualify?
Okay, so good. So good. Good question. So first off, when people hear $760,000, the first thing that people thinking of is I can't afford it. Mm-hmm. There is no way that I'm going to be able to afford $760,000 worth of coverage. The good news is I have seen policies before that are like $500,000, right? And maybe they're like 30, 40 bucks a month, right? So hopefully that gives people like a little bit of a sigh of relief. But yes, so let's go back to your question of how do you qualify? So when it comes to insurance companies, there's a couple different things that they're going to look at. They're going to look at your motor vehicle report. They're going to look at medications maybe that you have, and of course your medical records, your health record. Those are the three things. And I think it's important also to know about the motor vehicle report, because I sit down with a lot of people who like physically they're in great shape, not on any medications, great health, right? And they come back and then they might tell you later or something like, oh, by the way, I've had 3 speeding tickets in the past like 2 years or like past year. And all of a sudden their application is declined. I'm like, oh my goodness, you think this person's like an automatic approval. But that is something that insurance companies do look at, because you're more of a liability to them if you are a dangerous driver. So those are some things that companies will look at. Whether or not somebody qualifies, that part has nothing to do with the agent. It has entirely to do with the company. Okay. The company and every company is different, by the way. They all have their own guidelines. There are some companies that are willing to insure people with maybe a certain illness versus maybe another company who may say that's an automatic decline. And that ties back to why you should be sitting with somebody that maybe works for multiple carriers, because now they can go shop around and move to a different company that may be able to insure you.
Okay. So now we know you're speeding. Your speeding history could be a factor.
Yes.
Let's talk about medical. What about your medical? We know some people have an issue. I know big on, of course, smoker, non-smoker, but let's break that down a little bit as well too, when it comes to your medical, because you have to get, well, not everyone, but most people get medical examinations, right?
Yeah.
So let's talk about that a little bit. How does that work?
Okay. So I'll address a big one, right? Smoking or non-smoking. Can you still get approved for insurance as a smoker? Yes. Is it going to be more expensive than somebody that's a non-smoker? Yes. Now, where insurance companies had to start, modifying, I guess, their guidelines in terms of like what's approved or not approved is marijuana. Right? Because typically people will think when you do like an application, it'll ask tobacco or non-tobacco, right? And somebody might say, well, I don't smoke tobacco, right? But they still smoke, and they may smoke regularly. So every company kind of has their own, again, guidelines as to what they consider a smoker and what they consider to be maybe like a non-smoker. Yeah, and I'll kind of tell you the midpoint, I guess you could say, for their I guess I don't want to say ranking, but your, what would they call it? Your what's a good word for it? I guess like the classifications that they give. There's standard non-tobacco, there's standard tobacco, but standard is kind of like the midpoint, and then it can go up from there, meaning a good rating, and it can go down from there. So for somebody that is, let's say, a non-smoker, and let's say they are in great shape, right? They work out maybe every other day, healthy, no health issues. That person could be rated elite, right? They could be rated elite. And then let's say somebody who maybe they don't work out all the time, but they're not, overweight or anything, still a non-smoker, right? Maybe they're rated select, right? Select non-tobacco. Now, standard non-tobacco would be somebody who maybe is a little bit overweight, based on like their guidelines. They have ranges, maybe a little bit overweight, but still no serious health issues. Maybe they have asthma, right? That can be one that can put you in a standard category. And then from there, now you're going towards, there's another level right behind it that's more for like obese but non-smoker, right? Okay. It's all these categories. There's like, so then that's more of what they would call like express standard. Okay. Then from there, let's say you're going to tobacco. There's something called preferred tobacco, which is this person's in great, they're great shape. I mean, they work out, however, they just smoke. Right. That would be somebody that's preferred tobacco. And then from here, it kind of just reverses. So then somebody with a couple health issues, but they smoke. And then there's a person with a lot of health issues and they smoke. That person is the most likely to get declined, or have the most expensive rating. That's the word I was looking for, rating. They call them table ratings or ratings. So yeah, that's kind of how that gets broken down. Now, as far as marijuana and maybe tobacco, the way that companies do it is they kind of look at it this way. If you're a casual marijuana smoker, and by casual, I mean like, if you go out, you do it, right? Maybe like a party here and there, once or twice a month, you go out and you do that, right? Then you can still be considered a non-smoker if it's marijuana. Okay. However, if you are an everyday smoker, marijuana, right? Maybe you're not a tobacco user, but you are considered still a smoker. And so if you do an application, they might put you down as preferred tobacco, something like that. So that whole area for a while, I would say once it became like legalized in certain states, was something that we started to see with applications.
Okay, so and now it actually addresses that.
It does address that.
Oh, yeah. Wow. Okay.
It does. So, yep, it is something that is on applications. They do ask.
Okay, so basically what you're saying is quit smoking, lose some weight, and before you apply for.
This is the thing. If you want to come into insurance, if you want to come into your application in the best health that you could possibly be in, if that means running a couple miles or whatever, to drop a couple pounds, then by all means do it. But what I always tell people is this: you're never going to be younger than you are today, right? You're never going to be younger than you are at that very moment. At any point, something can happen. So the best time for people to get life insurance is obviously now, right? At that moment. And a lot of people don't know that you can also apply for insurance down the line. Like, let's say you already have life insurance. And you're like, I want to see, like, let's say in the past 5 years, you dropped 100 pounds. You can potentially go to another company and say, hey, I'm this weight, I'm healthier, and you can apply for insurance again at a better rating. It is possible. Now, obviously, 5 years from now, you're also going to be older. So in a lot of instances, they can end up offsetting each other. It's like, yeah, you're healthier, but now you're also older. Okay. Right? But those are little things to consider. But I would tell people, the best time for you to get life insurance is at that moment, in that current time, because that's probably the best time to make sure that in the event that something happens to me right after this call, or after you sit down with somebody, you want to make sure that you're always covered. I don't tell people to go wait. Like, I don't tell people, well, unless the person was declined, then I'll say yes, go, maybe you want to drop a couple pounds. For people that are diabetic, maybe you want to get your A1C ratings a little bit lower before you apply again, right? So yeah, but don't wait. Big mistake. Don't wait. Put in an application, see if you qualify. You never know, and then move accordingly from there.
Okay. So explain to us, how do you receive the death benefit, or how your people will receive the death benefit once you pass away?
So when you pass away, the family will receive the death benefit in the form of a check. Now, a lot of people will ask, well, how does the insurance company know that I passed? Right? How does the insurance company even know that I passed? Well, I've noticed that a lot of the challenges that the insurance industry has is they've built and they've attracted a lot of salespeople, right? This industry is full of salespeople. America doesn't have a salesperson issue. They have a leadership issue, right? Mm-hmm. The industry doesn't need more salespeople. They need more leaders and more educators. So when people say that, if you're not sitting down with, an agent that is, really looking to be there in the long run or looking to play the long-term game. I know people that get into the insurance because it's a very lucrative industry. They get in, they get out. But what you got to remember too is your name is tied to that person's policy, which means when something happens, who are they going to refer back to? You. So if you're planning to come into this industry, make a couple $100,000 and then leave, you also got to remember that that family is going to come back to you in a few years if that policy is needed and say, hey, how do we go about this? And you're like, I'm not in that industry anymore. I'm sorry. Maybe you can call the carrier, right? So first, you got to make sure that you're sitting down with somebody who plans to be in the industry for the long run. That's going to play a huge part as to whether or not you're going to be able to, get in contact and how to properly handle receiving the death benefit. And so even today, like we run an organization, and I was telling you this before, where we're developing, and I was telling you, 40% of what I do is insurance, right? But the other 60% is developing people, leaders, right? That are going into different communities and educating people on how to properly get insurance, how to build wealth through insurance. So sitting down with the right person, that's one, making sure that they're going to be there for the long term. And don't be afraid. Don't be afraid. And this will catch the wrong people off guard. Don't be afraid to ask your agent, how long do you plan to be in this industry? Don't be afraid to ask somebody that, because it'll catch the wrong person off guard, which is what you want to be able to weave out. If the person's like, oh, insurance is great. I think I'm just going to do it for maybe 2-3 years. I want to be able to, educate the community and hop out. I think I'm going to transition to. Be very careful about that, because that could be somebody that maybe isn't really, there for the reason of helping your family. Their intentions might be a little different. So, that's one part of it. But like I said, don't be afraid to ask somebody that. Say, how long do you actually plan on being in this industry? Because I just want to make sure, in an instance where, something happens, am I going to be able to reach you in the next 3, 4, 5 years if we need to access living benefits? And they'll tell you, right? They'll say, oh yeah, I do plan on being here, or, I do plan to transition out, whatever that case may be. So how will the insurance company know? The actual procedure would be, someone, you would call your agent. Your agent is always listed somewhere on the policy. Whoever wrote the insurance policy, they will be there, as well as their phone numbers, as well as the kind of like their information, their way of contacting them. And so you can call that agent. That agent will then relay the message to the company. They have a couple forms that you fill out, making sure that the beneficiary is who they say they are. And then that's how, they would distribute the money from there.
Okay. All right. So now let's get into some of the good stuff, right?
Okay.
So we know, because this is what this is all about, right? Building wealth and using it as a tool.
Yep.
So I know that's going to be the big question, because I think we kind of talking about it now. How does we leave a legacy, by getting the insurance, by making sure that, it's 10 times your current salary, your debt that you currently have, education for kids. We know all of those things, which is it's leaving a legacy. But how can we get insurance where it, benefits us while we're living as well?
Good. I think so many people hear life insurance and they think, this is a product for when I die. Like that's just I would say 90% of people think that. So how to leverage life insurance while you're alive? There's two ways. There's one aspect of, if I become sick, ill, disabled, right? How can I use life insurance while I'm alive? There's something called living benefits, right? There's something called living benefits. And not everybody, I found that not every policy, in fact, I would say a good 70 to 80% of the policies that I review don't have all four. There's four types of living benefits. There's a chronic illness, there's a critical illness, there's terminal illness, and there's critical and critical injury. That's the other one. There's critical injury, chronic illness, chronic Jesus, there's so many. Okay. Critical injury, critical illness, chronic illness, and terminal illness. There we go. Jesus. Those are the four. And I found that a lot of people have terminal illness, which means if you get diagnosed with a terminal illness like cancer, the company will pay you a certain amount, either in a monthly, like a disperse, or a lump sum, right? But I've also found that in these policies, if they do have them, they're only accelerating up to 40% of the death benefit, right? A good insurance policy should accelerate anywhere up to, I would say, between 70 and 90% of the death benefit in the event that somebody has one of those four. Okay. So those are things that you got to look for. And it doesn't hurt, I always tell people, to have your policy reviewed after a certain amount of years. You never know what things might change. You want to make sure, is my policy still, applicable to certain things? I never forget it. I looked at one policy, and in the fine print, this is why I love doing policy reviews, because you can find all these little things. So in the policy, it actually said, in the event of a pandemic, this person is not certain benefits do not apply. Well, we were in the middle of a pandemic, and if that person would have gotten sick, they would have been like, well, thank God I got life insurance, but your policy doesn't cover that. So, having policy reviews is something that a lot of people don't talk about. They kind of just get the insurance and they throw it in the safe, right? Or they throw it in the files, right? But having it reviewed, making sure that it's still up to date and things still apply, that is very important, having that review. So, there's the aspect of living benefits where, I'll give you an example. My mentor, his uncle was diagnosed with cancer. I want to say it's like 2017, right? He was diagnosed with cancer, lost like 80 pounds in like 2 months, was working as an engineer, making multiple six figures, but was the breadwinner for his family, meaning his wife didn't work, was just there taking care of the kids and his wife. And when he got diagnosed with cancer, his job was telling him, hey, you got to come in. We need you. We need you for, this project, all this stuff. And once he finished up with he was going through chemo, all of this stuff, they let him go. They let him go. So he had a policy. He sat down with an agent, I think maybe 10 years ago, at the time, maybe put about $15,000 into the policy over the course of 10 years. And take a wild guess. I just want you to guess how much that policy, how much do you think that policy actually paid out to him after having that policy that long?
So you said he had the policy for 15 years?
No, about 10 years. And he put about maybe 15,000 into it over the course of those 10 years. How much do you think it paid out to him for cancer?
I'm gonna say 350K.
$1.2 million.
1.2
million. So because of that policy, he was able to obviously get the medical care, go through chemo. Here's the part that a lot of people don't know about it. It was able to still put food on the table, pay the bills. I think a lot of times people think it has to go all into the medical bills, or it has to go all into the treatment because it's life insurance. When the insurance company cuts a check to you, the check does not say must go to XYZ. It doesn't. So it's a lump sum of money. So can you use it to keep to pay your bills and keep the lights on? Absolutely. Right. So he was able to do that. He's alive today because of it. So I think it's a very interesting story. Because a lot of people don't think about how you could use life insurance while you're alive. You don't have to pass away to use it, but it could be the very thing that keeps your family and your household intact when something like that happens, right? That's the living benefit side. And then the last part to it is building the wealth. Now, this is the part that I think is a little bit, more interesting to people today, because building wealth has become a phrase that a lot of people are using today. So I guess we're all trying to figure out, how do we build wealth for ourselves? And this goes into different types of permanent life insurance. There are certain policies, specifically indexed products, that can be
first before you get into that, right?
Yeah.
Can you use term to build wealth?
No.
Okay, I just wanted to throw that out there before you go into this. I want it so people can know the difference.
You can't use it to build wealth. No. Okay. Can you use it to pass down money? Yes, because there is a death benefit. But in order to build wealth, no, it will not work for that.
Okay.
So with the permanent product, specifically, I'll go into indexed products. Because I think this one is a little bit safer to people sometimes. It's a little bit safer to people. With index products, you're talking about a life insurance policy that one, lasts a lifetime, and then two, has like a cash value aspect, right? Meaning it works like a savings account. Okay. And the way that this savings account works is it's going to grow at a faster interest rate than, say, your average bank. Okay. And I actually just looked at my own, because I have one for myself. I looked at my policy yesterday. I wanted to see what it did from 2020 to 2021. And I looked it up, and the interest was 9.75%. Now you got to remember, banks last year they weren't doing so well. Okay. And during the pandemic, you saw interest rates drop from 3% to 0.3%. Right? Like they dropped significantly. And so in that kind of, if you're somebody that's looking to build wealth, and you want to make sure that you're putting your money somewhere where you're actually going to see it grow, right? One thing we don't have control over is the stock market. We don't have control of it. So a reason a lot of people like index products is because they have something called principal protection. They don't have to worry about the risks of the market dropping. Okay, so they can grow their money at a higher interest rate. Sometimes it's between 0 and let's say 10%, right? 0 and 10%. Now, when the market crashes, the account will do 0. meaning they won't lose anything. They won't gain anything, but they won't lose anything either. So whatever amount is in there, it's locked at that amount. I would much rather stay where I'm at than lose money.
Mm-hmm.
Right? So when the market decides to go back up, this account will kind of mirror what the stock market does, which means if the market goes up, so does the market. But when the market goes down, that account will stay the same. And so when it comes to being able to build something long term, Warren Buffett is a very firm believer in insurance, and especially like index strategies because of this. He believes in gains without losses. How can I put my money in places where I can get upsides and I don't have to worry about losing? Mm-hmm. Right. So for him, this is a product where he's like, okay, I can put money here, right? It can grow when the market goes up, but I know that if it should anything happen in the market, my money's going to at least stay where it's at. And so for the average person today who maybe is not, exposed to this, or maybe has never heard of this could be a game changer. It could be a game changer for a lot of people, because we're only familiar with the term, right? So I think that's it's a pretty cool product. But I think you got to know why you're getting like the life insurance, because there have been instances where I've seen, maybe an IUL, which like an index universal life policy, isn't the best option. Sorry, I'm working from home, so it's a phone call.
Okay. So, all right, we're gonna stay here. So the question that I had, because okay, you said we can use it like a savings account. Mm-hmm. So, all right, I've been putting my money into it. I see that I have a cash value. I mean, what if I want to borrow against it? How can I do that? How can I borrow that money? How am I utilizing this money that I quote unquote, built as a savings account? Mm-hmm.
Yeah. So it's kind of simple. You can call the carrier, and depending on, the company that you're with, they all have different surrender periods, if that makes sense. So I always recommend, because insurance is not like it's not a quick way to make money. It's not a short-term, kind of thing. It's a long-term thing. I always recommend that you wait about 10 years, right, before touching it. The reason I say that is because companies will put a what they call a surrender charge there, meaning if you take out before a certain period, they could charge you, right? Mm-hmm. Now, if you're gonna take money out, it matters like what you're gonna do with it, because that'll determine whether or not this product is even for you. When you're taking money out, you can call the carrier and you can borrow against your cash value. Mm-hmm. Now, this may not be all companies, but the ones that I use more often, the way that you borrow is you're not really borrowing from your cash value. Okay. So when you say, hey, I want to borrow $10,000, right? Your cash value can be thought of as buying power. So you're not really taking money out of that savings. It's the company saying, well, you have $30,000 worth of buying power in your cash value. So you're like taking a loan from the company. You're taking a loan from a company, right? Mm-hmm. So your cash value, and this is why this is a little bit more beneficial, because your cash value is staying the same. It's still growing as if you never touched it, because you didn't touch it. The money's actually coming from the insurance company, but they're basing it off of what your buying power is in that cash value. So when you take that money out, you can go use it to, buy a car. You can use it to send kids to college. You can use it to, I even found out you can use it to pay back other loans with higher interest rates, right? I didn't know that. You could use the money in there to pay off another loan, except that loan that you're taking from the insurance company may have a smaller interest rate. So maybe more beneficial. There's that aspect where you're taking it as a loan from the company, and you do not have to pay it back. And I think this is why people will use life insurance to maybe buy a home, or to, make big purchases or like real estate, because there's that pressure that people have when they take out a loan from a bank of, well, if I don't, my credit, I got to make sure, I'm paying this back, or it'll affect my credit score, or, what is the interest rate? What if I have a variable interest rate, So there's a little bit less pressure when you're taking from the insurance company, because it's typically at a better interest rate, and you don't have to pay it back. Now, what happens if you don't pay it back? That's what people always say. Well, what if I don't pay it back then? So what will happen is it will grow. Like it's at an interest rate. So that loan will accrue interest. And what will happen is when you pass away, they will deduct it from the death benefit, assuming you never paid it back. So if you borrowed 10,000, let's say it grew to 15,000, you have $500,000 policy, your family will receive 485,000, because they deducted that amount back. So when people say, well, you don't have to pay it back, I'm like, the insurance company is going to get their money one way or another. Okay. You don't have to pay it back while you're alive. That's what I tell people. You don't have to pay it back while you're alive. Now, the other way that I've seen it, and this is a very smart way to use it, is you can use it as a business loan. Let's say you take it out to start a business. Well, if your intent is to start a business, then at some point you're assuming I'm going to make more money, right? I'm using this to start something that's going to generate me more money. And then that's a good way to start a business. You start generating money, you pay that loan back, and now you just started your company without, having that fear of, I just took a $30,000 loan from the bank. Now I got 5 years to make sure this business is profitable so that I can pay it back. There's a lot of pressure there. So I think that's another way that it would help somebody to take that money out and be able to use it for other things.
Okay. So I want to take this loan. Like, how do I qualify to borrow against my money that I built up in there? What's the process like? They need a background check, like going to a bank, you know what I mean?
No, not at all. So once you have your policy, that policy is yours. That money is yours. As long as, like I said, as long as you have that an amount in your cash value, and it, like I said, it's like buying power. As long as you have that buying power, you're fine. You can take it out as you please, right? But I always tell people, make sure it's not within that period where they have a surrender, charge or something like that. Because if you look on like an insurance illustration, it'll show you like the first 5 years, you'll see, like, not always, but you'll see something that says surrender value 0. It'll say 0, 0, 0 for like 5 years. And that's because the company is saying, we don't want you to take anything out. We want you to let it grow. Right. Then after that, you'll see year 6, you can take out $500. Year 7, you can take out $1,000, and so on and so forth. But it's not until that 10th year do you see the surrender value matches the accumulated value. So like you may have accumulated $5,000, let's say after year 4, after year 5, right? But it's only saying you can take out 500. So they don't match. But usually right around that 10th year, you'll see that they match. So you might have accumulated 15,000. It says you can take out 15,000, right? So that's usually where you see the buying, like the accumulated value match the surrender. But again, all of that stuff varies based on how you fund your policy. So if you overfund this policy, you may be able to touch more upfront, like in the first year or first 2 years. So that part, it just depends on how you're funding your policy.
Okay. Yeah, I think that's kind of how it works for me. But
yeah,
that's in the here or there.
Exactly. Well, I tell you this, you take good care of your policy will take good care of you. So, right. If you overfund your policy, not only does your cash value grow a lot faster, but you free up more money. There's more money for you to, touch sooner. And that's kind of a good way to use a IUL. And I always tell people IULs are meant to be overfunded. And I think if this is where you also got to be very careful, because if you're sitting down with an agent that doesn't really understand how IULs work, you could end up in an interesting situation where you're not really getting the most out of the policy. You're not getting the most out of it. It will work. It'll do its job, but you're not getting the most out of it.
So you telling me I can get an IUL insurance policy, which I already do, but we just hypothetically speaking.
You and me both.
We hypothetically speaking here. So I can get this policy, right? And I'm putting this money into it, monthly, and I build up a cash value and say 5 or 6 years, say I have a cash value of $13,000. You telling me I can call the company and borrow 10,000 of that 13,000. All I got to do is say, hey, I want to borrow it. There's no credit check, no background checks, like I do if I get a loan with some business. I mean, with some bank, none of that. I got the money, my buying power, I have that. So I can borrow it and just tell them I need the check. And it's that simple.
Yeah. So from my understanding, I've never seen like a situation where someone was like, hey, like I've got money there and they're saying I can't use it. That's a little bit, I've never seen that happen. So to answer your question, yes, you can do it. Background check, no. Because honestly, the company did a background check on you when they gave you the policy. You're fine there, but that money is your money to use. So yes, you can take it out and you can use it for whatever you want to use it for.
So if it's that simple, why people not using this?
Because a lot of people don't know about it. I think if more people knew about it or were exposed to it at some point, people would eventually want to use this policy for a lot of different things. But a huge part of, and I didn't really go into why I even came into this industry and why I stayed in this industry. Prior to this, my background was medicine. Right? I went to school, got my degree in biology, was dead set on the medical route. There was just tunnel vision. And then I said, you know what? I went to I took an MCAT camp course, whatever, at Kansas University, and they had a panel of medical students, and they said, well, what would you have done different? And a lot of them said, I would have took a gap year. And I'm like, okay, because you go from high school, then college, and then you go straight into medical school. And so they said, well, I would have took a gap year. So I said, okay, let me see. I'll take a gap year. In my gap year, I got introduced to entrepreneurship, was kind of like, let me see what this is about. And I ran into my mentor. My mentor was already in the insurance industry, runs a 7-figure agency in terms of insurance, and, was doing well for himself. It's actually somebody I went to school with. So it was interesting to see somebody a couple of years older than me already doing that. Got mentorship. And, I came into the industry with pretty much if I'm being honest, pretty much the same mindset as most people that initially come into the industry, which is, hey, I'm just going to use this as another stream of income. I think it's good information, cool. I can teach it. Great. Then I started to do some research. I said, okay, well, if I'm gonna be in an industry, let me do my own research. Let me learn a little bit more about it while I'm here. And I found an interesting statistic that said it would take African Americans 230 years for us to catch up to the majority, and the majority being the whites, right? And I said, okay, well, I'm not gonna be here to see that. I'm not going to be here in 230 years, right? So how can I shrink? How can I condense time, right? How can I close that gap for Hispanics 90 years before they catch up to the majority financially, right? It'll take them, at least it's a lifetime, but 90 years, right? So for that, it didn't sit well with me. So I said, if I'm going to come into an industry, I want to learn how I can make an impact here, how I can close that time frame. And so that is what I did. That's what I stayed in the industry because I realized that a lot of people in my community were not well versed when it came to money, were not familiar with how to use life insurance. And I said, okay, this is where I want to plant my flag. Everybody has already gone into real estate as how to build wealth. We're looking at stocks, we're looking at tech. Everybody has their own way of how they want to make an impact, right? I just chose financial services as my vehicle. So that is what kind of kept me in the industry, was how can we go out there? How can we educate different communities? And today, we're starting to, pioneer different states in different communities, because, here in Los Angeles, the issue of finances, it's not just here. It's not just here in LA. It's in, it's in Houston, it's in Detroit, it's in the Bronx, it's everywhere. So how can we really expand, right? How can we find leaders in different communities in different states that can be the voice, right? That can educate people on how life insurance can benefit long term. So that is actually what ended up keeping me in the industry, in the industry. So yeah, if more people knew about it, they'd probably use it.
Yes, I think so as well too. I don't know. For me, it was just really an epiphany type moment of research, really, because I'm not an insurance agent by far, but I just realized that, I'm asking these questions, of course, because I know that you can do that, the whole cash value. And one of my policies actually right now, I have over 40 grand. And so that I could borrow against right now. No questions asked. And I tried it out. I was like, hey, if I wanted to borrow against this $40,000, what would you need from me? All it is a form. You fill out a form that they'll send to you, whether electronically or in the mail, and you fill it out and you send it back to them. And they'll tell you the time frame, which usually 7 to 10 business days, you'll have your payment. And I was like, wow, like really? And so knowing that also I don't have to pay it back. So I would pay it back, but just that relief of I don't have to pay it back. So if I wanted to take the money, start a business, or if I wanted to take the money and buy a car and then create a car note for myself, right? Because now I'm my own bank. So it's like, okay, I'm gonna pay this policy back. Okay, I'm gonna pay $350 a month on this policy to help get it back up to where it needs to be. And then also knowing that even if I took that 40 grand out, it's still building interest as if that 40 grand is sitting there. So it's like a secure loan. If anybody knows about secure loans, banks still, I mean, you ain't getting no interest because we know the bank ain't, you know what I mean? But it's still, getting that 0.012% that you getting from the bank as it's, because you're paying it back, right? And so this is something that definitely is needed. And I think that we need to understand a lot more, because if you golf, go golfing. If anybody hasn't been, go to a golf course. Insurance, everything, like that's where they're going to be talking about insurance. You're going to be seeing insurance bulletin boards, insurance ads, like everywhere, where you don't really see it much other places, right? But you go golfing, you're going to see it all over the place. And so it's definitely a great thing, definitely a great thing. And I don't think we can kind of stress that enough, that everyone, not only to help pass down something to your family, but also how you can utilize it for yourself, and kind of take back some of your finances, especially from the interest rates. You said yours is 9.75. I think one of mine is like 9.65, and then the other one is like 8.75 right now. The interest that I'm building. And I don't know where you're going to get that from, any savings account, nowhere. You just can't. You're talking about, like you just said, index funds numbers. That's what you're looking at with that insurance policy, and good index funds at that. That's going to be for another one.
I know. And there was an article that came out recently And I thought about what our organization has been doing, the agents that we've, been able to train and teach on how to, educate on insurance. And there was this article that came out saying that in the year 2020, more African Americans bought insurance than any other group. And I was like, wow. And I'm like, where is that coming from? Because the average agent today is I'd say 59, 60-year-old white male. So who's sitting in front of all of these people that's making them become, more aware and of what's going on with insurance and how to use it? Why did we see this huge, rush of African Americans becoming more aware of life insurance and purchasing life insurance? It's one thing to be aware, it's another thing to actually act on it, right? So how are we're seeing this, huge jump in this spike of African Americans getting life insurance? They purchased insurance last year, life insurance, more than any other group, right? And then there's a lot of different factors into that, but I thought that was very interesting because our organization today is very diverse. The average agent is, either female, and then between, the average age I would say is 34, Latino or African American female. So, and when you do that and you start to look at how numbers are starting to shift and change, we're doing something very powerful in the industry. And for the people that, are very serious about going out there and making a change or making a difference, you don't have to be the biggest company. You don't have to be, the one that's been around the longest, right? If you have a vision, you have a goal or something that you want to be able to do, you're never too small to go out there and do it, right? Mm-hmm. You're not. And so as long as you have good intentions, you want to go out there, help people, you genuinely want to help people, you're willing to outwork your competition, you're willing to outlast and out strategize, you will start to see the benefits, and you'll start to see the change. So it was good to see that article because it kind of let me know that what we're doing is actually working. There is some type of good that's coming out of this. We're seeing it. So I think it was good to see that article.
Okay. Yeah, that's awesome. So, well, man, I really appreciate, you taking the time out to do this. Like I told you before, got another son coming in November. So your work is still not done because you got to insure another family member.
Absolutely. No. I love it because they're starting early. He will be, and I don't know if did I just do a gender reveal? I don't know. Is it a boy? It's
a boy. It's another
boy. Yeah, all right, cool. I was like, I don't know if I was supposed to give it. Okay, I gave it away. I said he. But yeah, he's gonna start off early. And I think the key is doing that, starting off while they're young, starting off while they're early, because if all this child knows is, well, I grew up with an insurance policy. I don't know anything. I don't know what it's like to not have an insurance policy. Then that is where the new cycle begins.
Yes. So just to give you some information about how I'm doing it, like you're going to have one. So in my will, for my son to get the money, my sons to get the money, they're going to have to set up and structure everything the way I've structured it.
I love it.
So no one is just going to be getting money. No, you're going to be setting and structuring the same thing for generations to come. So this is just going to be the norm. And you're going to have to do it in your will the same way that I'm doing it. You see what I'm saying? So that way now we're building that wealth together. And also, because you think about it, right? If this is something that was done for you, it takes the pressure off of you in life, right? So now think about it. I look at it like, I would have loved to have been an educator or a teacher, and maybe at some point I will. But, thinking about when I was younger, I'm like, ain't no money. You know what I'm saying? So you think about that when you had generational wealth passed down to you, you can live in your best self. You know what I'm saying? So if you want to be a teacher, by all means, because money, you've been taught how to create money as well. So do what you want to do. You know what I'm saying? And so, yeah, man, it's going to be that way from here on out. Everyone's got to do it. So
That's where it starts. I love it.
yeah, man. But shout out your socials, man. Give us how can people get connected to you? Your
Man,
socials, your information, your
absolutely.
websites, all that. Give it to us.
Absolutely. So the best way to reach me is through, you could reach me through social media. I'm more active on Instagram. My handle is at Teyha Laren. So at Teyha.Laren, TEHYA.LAREN. And I'm pretty active on there. So if I see a DM, if somebody has a question, they feel free to ask. I'd be more than happy to do that. And if we want to set anything up where you just want to learn a little bit more, by all means, I pretty much make my own schedule. So I try to work with people. So if you're on the East Coast, let's figure something out. If you're on the West Coast, that's my time zone in California. So we can definitely work something out there. But that is probably one of the fastest ways to reach me. And then, of course, if you are close, if you are connected to Adrian, just let me know. And he'll be able to give you my information. I have no problem with that as well. And if you do, just let me know. Just say, hey, Adrian sent me, and that'll be awesome. So, yep.
Oh man. Well, I appreciate your time. And we're definitely gonna have to do it again, because this is something that we're gonna have to keep the word going and keep making sure that we educate our people on, because this is major. This is a major key that I think that people just don't really understand, but we're gonna get them there.
Yes. We gotta keep putting it out there. So people are getting exposed to the information. So I appreciate it. Thank you so much for having me. Like I said, what you're doing is huge. It's a game changer. And as long as we keep pushing out this information, eventually it will start to reach the masses. And that's what's the most important right now is getting the information out there. And then, of course, once we have the information, how are we actively using it? And I think that's the next step to this. So thank you so much for your time, Adrian. Always going out there and giving people the gems, dropping gems here and there. So I appreciate it.
I try to do what I do. I appreciate it.
I love it.